So welcome to part 3 of this video series on how to use options to trade stocks, and we're using Tesla as a case study. Now there are many different option strategies. Again, I'm just sharing the 4 simplest strategies. In the first 2 parts of this video, I talked about the simplest method, which is to buy call options, just buying straight call options, which is what most amateurs do. And the second method I talked about was buying bull call spreads, which is buying a call option and selling another call option at the same time. So we call that a bull call spread. And the third approach, which I showed you in the last video, was called a bullish synthetic spread. So in this video, I'll be showing you the final strategy, the one that I use like most of the time, like 95% of the time, I'm using the 4th method, and I'll explain why in a while. So before I continue, let me make it very clear, because I've been reading some of the comments in the first 2 videos. So I'd like to clarify something, that options should only be used for trading. Never use options for investing. It's a totally different game. Now again, what's the difference? When I make an investment in a stock, my time frame is I'm looking to hold it for 5, 10, 15 years, looking for it to compound to huge amounts of money. As an investor, I don't have a stop loss. If the price drops, I keep buying more and more and more, because I believe in the fundamentals of the business. It's a great business. Okay, so that's investing. So for example, I invest in McDonald's, I invest in Visa, I invest in MasterCard, I invest in Microsoft, right? So that's investing. Now, I'm talking now about trading, which is different. So again, the analogy is like investing is you're getting married till death do us part. Trading is a one-night stand. So it's very different. So in trading, when you enter a trade, you got to always have a stop loss level, where if the price drops to a certain level, you have to cut loss. And when it reaches a certain level, you want to take profit. So it's a very different concept, trading and investing. Never mix them up. And I've said this many times before, that some stocks are good for investing, but may not be good for trading. And some stocks may be good for trading and not investing. It's kind of like relationships. Some people make very good girlfriends and boyfriends and one-night stands, but they may not make good husbands and wives, because they're not loyal, they're not dependable. So you've got to be very clear. So I've said this many times before, that for me personally, Tesla is not a stock that I would invest in. I'm just not comfortable investing in Tesla to get married to Elon Musk. No, it's just not me. But do I trade Tesla? Yes, I trade it all the time. I trade it when it's going up, I go long. When it's going down, I go short, right? So bear in mind that, again, these options strategies are for trading only, never for investing. Okay, so with that being said, let's jump in. Now, so the first 3 methods I showed you, I shared with you what were the pros and cons. So buying a call, let me just review. So buying a call is the simplest thing to do. That's what most people do. They just buy a call option, and if the price goes up very fast, yes, you can make money from it. That's a great thing. But the disadvantage of buying a call option is that it's very expensive. And if the price doesn't go up fast enough, or doesn't go up by an amount that's enough, it can't cover the cost of the call, and you can lose money, right? So that's the disadvantage of a call option. So to mitigate that, you do a bull call spread, which is you buy a call and you sell another call at the target price. Because by doing that, by selling the call, you collect the premium to finance the call you bought. So that lowers your cost, lowers your risk. So that's the advantage of the bull call spread. But for the first 2 methods, you are subjected to time decay. Remember, when you buy options, it's a decaying asset. Every day you hold it is losing value, right? So if the price doesn't move up fast enough, you will lose money. So even if the price goes up, but goes up slowly, you still lose money buying calls or buying bull call spreads. So the third method, which is the bullish synthetic, is a method that doesn't have the time decay risk. Because in a bullish synthetic, you buy a call and sell a put at the same strike price. Why? Basically, you sell a put, collect the premium to pay for the call, so it's a zero cost trade. So again, a bullish synthetic is equivalent to buying 100 shares of stock, the same profit and loss, but it's a zero cost. In other words, you don't pay for any kind of premium. There's no time value decay, right? So those were the first three methods. Now, I rarely use the first three methods. I do it sometimes if I'm really bullish, okay? But I mentioned for Tesla, I'm not really bullish. I'm like neutral to moderately bullish. So in cases like that where you're not sure if it's going to go up, it may go sideways, then you want to use the fourth method I'm going to talk about. Now, why do I love the fourth method? Because the first three methods, they require the stock price to go up to make money, right? So in the first three methods, if the stock price doesn't go up, it goes sideways or goes down, you will lose money. I don't like that, okay? Because you've got to be right on the direction. I want a method where I make money, whether it goes up, goes sideways, or even goes down a bit, I still make money. That's what I want. So that's the fourth method I'm going to show you right now, and it's called the bull put spread, also known as the put credit spread. So let me explain this step by step. So for this strategy, instead of using call options to kind of like go long, we're going to use put options to go long. So this is how it works. So for example, for Tesla, if I am moderately bullish, right, I think that the price will go up or go sideways or go down a bit, I want to make money in all directions. So what I do is I will sell a put option below the current price. Now, how far below, I'll show you in a while, but we want to make it low enough such that we don't think the price will get there easily, right? So let's say, for example, I will choose, right now, Tesla's at 180, so let me choose about $157, somewhere here, okay? So at this level here, about 157, I will sell a put option, right? Now, why sell a put option? Remember, when you sell a put option, you collect premium. You get money. That's what we want. We call that a credit. Okay, we want money, right? Okay. But by selling a put option, what happens? Now I'm obligated, as a put seller, I'm obligated that if the price goes below that put option level, let's again call this 157, for example, we call that the strike price. If the price goes below 157 and closes below 157, then I'm obligated to buy 100 shares of Tesla at the strike price. Now you may say, but I don't want to buy 100 shares, I don't want to own the shares. Okay, great. So if you don't want to end up owning the shares and being obligated to buy the shares, what then you do is you buy a put here below that put you sold. You buy another put at about $5 below that, let's call this 152, to hedge that first put. So basically what happens is this. Remember, when you sell a put, you're obligated to buy the shares if it goes below that price. But when you buy a put, now you have the right to sell back the shares. So it hedges each other, okay? So another way to think about it is when you sell a put, you're like selling insurance and you're collecting a premium. But what if it goes down? Then you have to buy reinsurance, all right? So we're selling insurance at 157 and we are buying reinsurance at 152. Now, the idea is when you sell a put, you will collect some money, okay? You collect some money over here. But when you buy a put, you have to pay money. But you collect more than you pay. So net, you get a credit. You get paid for entering the trade. And so we call this a credit spread. So once you set up the trade, the beautiful thing is that whether the stock price goes up or the stock price goes sideways or the stock price goes down, you will make money in all directions as long as the price doesn't go below this 157 level, which is the strike price of the put that you sold. If it goes below 157, you have to close a trade and cut loss, and yes, you will lose money. You know, there's no sure win thing. There's always a risk in every trade. But the great thing about this is that your profit zone is very, very wide. In most trading, you need the price to go up to make money. or go down to make money. You have to be right on the direction. But the great thing about this method is you don't have to be right on the direction. As long as it doesn't go down too low, it's a profitable trade. So later I'm going to show you that when you enter the trade, you sell and buy options with a certain date to expiration. So usually I would choose between 30 to about 40 days expiration, roughly about that, 30 to even 45 days. Which means that in 30 to 45 days, as long as the price doesn't go below 157, you will have the maximum profit. One of the reasons that I prefer this strategy is that, remember, a stock can do three things, right? It can go up, it can go down, or it can go sideways. So if you only bet that it's going to go up, then you are only right 1 in 3 scenarios. But in this strategy, if it goes up, you make money. If it goes sideways, you make money, right? So you are right on 2 out of 3 outcomes. So it gives you a very high win rate of over 70%. In fact, in many trades I take, it's more than 75% win rate. So this is a great method if you're not very bullish. If you're very bullish, fine, buy a bull call spread, buy a bullish synthetic if you're really, really bullish, right? But if you're kind of like, I'm not sure, may go up, may go sideways, may go down a bit, I'm not sure, this is a great strategy. So let's see how you could set up a bull put spread on Tesla. So the first thing is to go to the trade tab. Again, you can use any broker that you want and select the date to expiration. So usually when we sell credit spreads, we want to sell between 30 to 45 days. That's a sweet spot thereabouts, right? So let's choose, let's say this one, which expires on the 28th of April in 41 days, right? Now you may say, could I choose 21st April? Yeah, you could, right? Either one is fine. All right, so let's choose this one. Let me open that up. Boom, okay. So we're looking at puts here. And so first we need to sell a put and then buy another put below that, right? Sell insurance, buy reinsurance. So the put that you sell, what strike price do you select, okay? Now it all depends on the delta, right? Delta is the most important thing. So I want to sell a put where ideally the delta is between kind of like, ideally between 23 to maximum 30 deltas. 23 to 30 deltas. That's kind of like the sweet spot, okay? So now, I like to sell, of course, the lower the delta, the better, right? The lower the better, but if it's too low, you don't get enough premium. And that's why you have to sell between about 22 to 30, right? Now, so in this case, I would sell the 24 delta strike, which is I will sell the put option at a strike price of 157.5. Okay, I'm going to do that one. Okay, so by selling this option, how much do I collect? How much money do I get? I will get $6.60 per share. Okay, but to hedge it, I have to buy another option below that. And usually I choose about a $5 distance. So what's $5 below 157.5? Is 152.5, right? Which is this guy. Okay, so I'm going to sell, let me write this down. I'm going to sell this guy, I'm going to sell this put option and collect $6.60. And I'm going to buy the 152.5. And by buying this, I have to pay $5.50. So I collect $6.60. I pay $5.50. Net, I keep $1.10. That's a credit. So you've got to always make sure that you've got a credit of at least $1 for a $5 distance, right? If the difference of the strike is $5, you've got to collect at least $1 of that. Now, what the hell does delta mean, right? Now, delta means a lot of things, but one of the things that delta means is that by selling at 24 delta, that means that there's roughly a 24% probability that the stock price will drop below 157.5 and close below that. There's only a 24% chance of that happening, which we don't want, because if it drops to that, we lose money, right? We want it to stay above 157.5. So theoretically, by choosing the 24 delta, that means that theoretically, there's a 76% chance of you making money, which is not bad, right? Like I said, I want at least a 70% chance of making money, at least a 70% win rate. Now, these probabilities is not something I pull out of my ass, right? These are actual statistics generated by the system, okay? So it's based on probability. Got it? All right. So let me show you how I would set that up. So first thing, I would sell this one, click sell, boom, right? So I'm selling. -1 means selling one contract. I'm selling the 157.5 and I'm gonna buy the 152.5. Boom, there we go. Here we go. All right. So I'm selling this, I'm buying this, and credit, I call it a credit of $1.10. Now, very important, you have to get at least minimum $1 credit for a $5 strike distance. So if it turns out to be a winning trade, your profit will be $1.10. Now, per contract, one contract is 100 shares. So you have to multiply by 100, which means that for a winning trade, you will get $110 profit. Now, you know, in every trading, there's no such thing as only profit. There is loss as well if it's a losing trade. So you got to know what's your profit, what's your loss, what's your risk, what's your reward. Okay. Now, if you were to click this to send in the order, you can see over here that yep, your maximum profit in this trade is $110, but your maximum loss is $390. Now, some of you may be thinking, Adam, are you nuts? Are you crazy? Why do I want to earn $110 when I can lose $390? Right? The risk is so big versus the reward. So could you actually lose $390 on this trade? Yes, you can, if you allow the stock price to drop below the strike price of the put you sold, which was 157.5, and let it expire. Then you can lose $390. So this is something that should never happen. In all my years of trading strategy, I've never lost this. Why? Because I managed the trade based on the cut loss rule. The cut loss rule is this: the moment the stock price drops to the strike price of the put you sold, in this case 157.5, you have to close the trade immediately, the cut loss immediately, and not let it expire. Okay, so if you do that, you will not lose $390, you will lose a lot less, and that's what makes this strategy very profitable. So let's take a closer look at the actual profit and loss of trading this strategy. Now, before that, let's go back to the charts and let's see how this trade actually looks on the chart. So again, recall that right now Tesla's at 180 and we sold a put option at the 157.5 strike price. So this red line is kind of like our point of no return. That's our line in the sand, right? We sold the 157 and we then bought the 152.5 below that. So again, once we enter the trade, we have got about 40 days, all right? So in the next 40 days, the price can go up, the price can go sideways, the price can go down, no worries. But the moment the price drops to 157.5, we close the trade immediately. We got to cut loss immediately. That's the rule. Don't let it go below that and stay there to expiration. Then you can lose $390, all right? Or you can lose almost 4 times the credit you collected. So that's really stupid. Don't ever do that. Now again, what's the probability of the price dropping and going below 157.5? Well, again, based on the delta of the put we sold, the chance is about 24% chance of it dropping below 157.5 and then expiring below that level, right? So we've got kind of like a more than 70% chance of the price staying within this zone, which is a very good win rate. Well, let's take a look at the actual profit and loss chart to get a clearer understanding of how to manage a trade. So let me open up the profit and loss chart. Okay, there we go. So this is what it looks like. Let me just delete these first few. Okay, so what's the date today? The date today, let's assume you enter the trade tomorrow, which is the 20th of March. Let's go to 20th of March. There we go. All right, so this is what the trade looks like. Now again, let me orientate you. What's the current price of Tesla right now? Current price is there, 180, right? And at what price must we cut loss? We must cut loss if Tesla falls to 157.5, which is the strike price of the put that we sold, right? So where's our cut loss? Our cut loss will be this line. Let me move that line to here, roughly about there. Okay, got it? Okay, so this is our stop loss price. So the moment it gets there, we have to close the trade and cut loss and get out and run. Okay, so we've got 40 days for the price to stay there, go up, go down, ding dong, ding dong, ding dong, ding dong, as long as it doesn't hit this point of no return. Now, so once you enter the trade, notice that your profit and loss is this purple line. That's the purple line. The green line would be your profit at expiration. Now, in all the other option strategies, remember that time is working against you. Every day that passes, you are losing money because the options are losing value. But in this strategy, is the complete opposite. Time is working in your favor. Every day that passes, you're making more money and more money and more money, right? Because every day that passes, the purple line, let me show you, from the 20th of March, I'm going to go to 21st of March, right? 22nd, 23rd. Now, look at what happens to the purple line as we move to expiration. Can you see what's happening to the purple line? The purple line is moving to the green line. Can you see that? Until eventually, on the 28th of April, the purple line will become the green line, and that's when you will realize the maximum profit of $110. Okay? So as time passes, you will see your profits grow until they maximize at expiration. So let's go back right now to the 20th of March, which is the day we so-called enter the trade. Now, again, what happens if you enter the trade and the stock price drops immediately? Let's say it drops immediately the next day, on the 21st of March, it drops to our stop loss price and we cut loss. How much will we lose? How much will we lose, right? Very simple. Put your mouse there at the purple line and you can see the box, how much you would lose if it drops the next day. You would lose $99.15. Okay, you would lose $99.15 if it drops immediately. That's how much you lose. Okay, so you're risking $99.15. That's how much you will lose. But if it's a winning trade, right, you will make $110 in this example. So that's not a bad deal, right? That's not a bad deal. Now, that's if it drops immediately. But if it doesn't drop immediately to the stop loss, it takes a while to drop. It takes 10 or 15 days to drop there. Look at what happens. Notice that as time passes, the purple line will start to go up. Can you see that? It'll start to go up. So if it drops down later, it's actually better because now that it drops down to the purple line, now instead of losing $99, you lose only $48. So that's what I like about this strategy, that as time passes, you lose less. Even if the price drops, you will actually lose less. And as long as the price stays above 157.5, you will keep making more and more and more until expiration date, you get the full $110. So let me give you two words of caution. The first word of caution is this. Now, in this example, you can see that if it drops to the stop loss price and I cut loss, I only lose $99, which is less than the credit I collected. But that's not always the case. There could be cases where if the price drops and the volatility increases a lot and you close a trade at the strike price of the sold put, you can actually lose more than the credit that you collect. In fact, you can even lose sometimes up to 1.5 times more about that. So in other words, roughly, if you close the trade, you could actually lose $150, which is more than the credit you collected. It can happen. right? It can happen sometimes. Now, the other thing that you have to be cautious about is that if the price drops and you let it expire, right? You let it expire, you can lose the entire $390. And like I said, that has never happened to me in my life, because the moment it gets there, I close it, I don't let it expire. But for people who may forget about this trade, which you should never do that, you could actually lose that full amount. So you have to be cautious about that. So when managed properly and executed properly, this is actually a very, very profitable strategy. And that's why it remains my favorite strategy. Now again, remember, in trading, when you enter a trade, there's no way to tell, is it going to be a winning trade or is it going to be a losing trade? Any trade can be a winning trade, any trade can be a losing trade. But over a large sample of trades, this strategy gives you over a 70% win rate. Now, if you're winning 70% of the time and you're risking $1 to make $1, that's very profitable. Or even at times you're actually losing $1.50 to make $1, but you're winning $1 70% of the time, it's a very profitable strategy. And that's why it remains my preferred strategy in trading. Now, a final word is that just bear in mind that I'm using Tesla as just a case study. Am I actually going to enter this trade? No, I'm not. And so the one reason I'm not entering the trade is because Tesla is going to announce earnings, as you can see on the 19th of April. It's going to announce earnings. And one of my rules is that I never enter an option trade before earnings. I want to make sure that I enter the trade and it expires before the earnings are announced. But because there's earnings coming up, this invalidates this trade, right? But I want to show it to you as an example. But again, for those of you who want to learn to trade this, I do suggest taking our professional options trading course and learning everything about how to manage these trades, because this is just an introduction. And if you want to watch me live, watch my actual live trades and get live alerts when I enter a trade, I exit a trade, you can subscribe to the Ultimate Investors Playbook, or UIP, where I do share my option trades as well. So let me give you a few examples of some trades that I entered and I exited over the last couple of days. For example, one of them that let me see where that is. There we are, right? So I just closed my TXN bull put spread for 95% profit. That's Texas Instruments, and I'll show you the original trade, right? There we are. That's the original trade where I entered a bull put spread, where I sold the 165 put and I bought the 160 put on 26th of January. So let me just show that to you right here. This is the TXN, which is the Texas Instruments. All right. So again, this trade I entered on the 26th of January, which was, yep, somewhere here, right? So what I did was I sold the 165 put. I sold this put and I bought the 160 put. Okay. So in other words, as long as the price doesn't get below there, I'm profitable. And the price like went up, went down, never touched that. And so I got out for a 95% realized profit. So once again, if you want to learn how I invest and trade live and watch my investment and trade alerts, you can subscribe at insight.piranhaprofits.com. So hope you enjoyed this video. May the markets be with you, and I'll see you soon.